it's entirely possible and plausible and conceivable that you can see a $30 silver bump in a day for consecutive days. And that will require a halt of the COMEX. But you gotta buy the physical market. That is the only way that you're protected. The paper market, you are gonna be, I mean, what are you gonna do? You're gonna go and complain and file a class action lawsuit? I mean, you know, they're gonna settle you a few extra cents on the dollar, and it's gonna take you forever. And in the meantime, you're gonna miss that window of 6 to 9 months where the greatest gain is achieved.
Hey everybody, Smart Silver Stacker here. Today I have got a special guest on the channel. He's a chartered financial analyst and the chairman and CEO of Elephant Mining Corporation. So let's welcome John Lee on the channel here. He's here to give us some insight into the recent moves in the gold and silver market, and he'll also share with us his forecast for where the precious metals are headed from here. So thanks for joining us, John. Please take a moment just to tell us a little bit about yourself.
Well, thank you, Smart Silver Stacker, for the invitation to be on your show for the first time. I am, like you said, I'm a chartered financial analyst with over 20 years of experience in the metals and mining investment. I started out in the first 10 years as a retail investor. So I started buying silver and gold, silver at $4 back in 2003. And in the last 10 years, from 2009 to 2023, it's about 14 years, I spent the latter decade running a silver mining company. Started out, honestly, Smart Silver Stackers as a hobby that time flew, and 14 years later, I'm still at it. It's a triple full-time job.
That's great. Yeah, that's how I think a lot of us get started in the space. You know, we hear about physical bullion, or, you know, you hear a little bit about inflation hedging, you get your hands on your first couple coins, and then kind of becomes all consuming for some of us, you know. It definitely becomes a very addictive hobby for some.
Well, you know what? It's something that it's a bit of a rabbit hole, right? You take the red pill and you see how deep it goes. So my specialization is silver. When I started out in 2002 or 2003, when Gordon Brown dumped the last batch of gold at $250, I think silver was like less than $4 at the time. I was researching everything under the sun. So David Morgan is a very good friend of mine. I've read over all the pieces of Ted Butler, and I was also involved in some of the work that GATA does. You know, after I transitioned into on the mining company side, I don't research gold and silver as much as I was before in the last few years. Mm-hmm. But on the mining side, I was running a silver mining company and raised over $150 million through the Canadian Stock Exchange. So I've got that different perspective of looking at both the physical side and also as from the mining supply perspective. And not to mention that I'm a Taiwanese native. I've traveled over 40 countries and lived 3 different continents.
Well, I'm certainly excited to get your insight into things from that point of view. And, you know, yeah, getting started back then when silver was around $4 an ounce, you started a bit before I did. I kind of started following the 2008 financial crisis. But, right. You know, one thing I hear a lot in the comments and just in this space in general is that, you know, silver stackers, gold stackers, they've been singing the same tune for a long time. But my response to that is that, you know, this crisis that we're facing, it's been in the works for a long time. And the longer it goes, you know, the Fed keeping interest rates so low for so long and kind of manipulating the economy for so long, ultimately that means that I believe the price that we see for both gold and silver is going to be that much higher, you know, the longer this financial bubble has been in the works. And on that topic, you know, kind of reaching the terminal phase here, at least it seems that way to me in this gold and silver story. We've seen both metals going up quite a bit over the past couple of months, especially following the collapse of SVB and Signature Bank. And if you look at the charts, we've seen the metals go up not only in nominal terms, but also really in real terms, because if you take a look at the US dollar index, it has been, with some fluctuations, relatively flat over the past couple months. We're kind of at the same level we were at in February, but at the same time, the metals are up. So when you look at the world stage and you've got bank failures, you've got the Fed expanding its balance sheet once again, following the collapse of SVB and Signature Bank. And then at the same time, you've got all this geopolitical uncertainty surrounding Taiwan and also in Europe, Russia and Ukraine, and this de-dollarization trend. what do you view the big catalyst driving this increase in the precious metals at the moment as being? Is it a combination of factors, or is there one that you kind of would focus on?
Well, yes, Smart Silver Stacker, you have mentioned several. You have several factors. I think they're all fundamentally driven and pro gold and silver. Regarding the dollar index, what we see today is quite similar to back in 1980, when you have a rising interest rates, a rising dollar coupled with rising gold and silver prices. The price of gold and silver is always being managed. The way I look at it is almost like water, and that is the liquidity, right? The fiat printing. And then you have a dam. So the water will continue to rise. The price management or the price discovery for many markets long gone. If you look at the oil market, it went to negative. That's unfathomable. So all that the sort of the management or the cartels can do is to modulate the rise in gold and silver physical, to try to contain silver prices, trying to contain, to make it as unsexy as it could be. So they even created the cryptocurrency to sort of create that distraction for you. But I just want to remind your audience, like if you look at in terms of the long-term appreciation, I'm talking 3 to 5 year medium term or 10 to 20 year out. I got in the gold market in 2002 and gold is $250 an ounce. I also bought a condo in Vancouver at that time, and I paid $300 or $250 square foot. And now the condo in Vancouver is going for about $1,250. So it's gone up about 5 times. But if you look at price of gold, it's gone up 8 times. So while you can analyze and sort of microscopic or sort of looking at the micro level of how gold and silver are doing on a day-to-day basis, but make no mistake, like silver's $4 and now is $25. That even in the long haul, they are outperforming many other different asset classes. So, and you talked about how this time will be different. There's inflation, there's banking failures, and there's also the different geopolitical factors. I've come on many different shows before. How this time is really very different, as we're entering a great reset, is the dollar hegemony. If you look at the Bretton Woods two accords back in the 1970s, people were standardizing on the dollar. The world was standardizing the dollar as a matter of convenience. The Saudis were the US's biggest buyer of Saudi oil. And so the Saudi was taking the dollars and in turn, repatriating that dollar to the United States to buy weapons. And in the 90s, China was going through its own industrialization. So it was shipping its goods to overpriced goods for overpriced currency. But now we're seeing sort of a rapid decline of the China export to United States, and they're at war economically. Make no mistake about it. And it's going to get a lot worse. And the Saudi and U.S. relationship is also broken down, not only because U.S. is no longer Saudi's biggest customer, the United States is near oil self-dependent, but Saudi doesn't like oil, United States browsing its nose into what Saudi is doing with Yemen, and it's all their business. So I think the dollar is in a very capricious position, and that if China were to attack Taiwan and U.S. stands by, and then Japan is going to think twice about its $670 billion of U.S. dollar holding, and having to sort of looking at other insurance policy, and keep in mind that it was the U.S. that bombed Hiroshima in World War II not so long ago. So I think there's a lot of marriage arrangements of convenience, but collectively looking at over $2 trillion, maybe even more, Saudi's dollars, China's dollars, Japan's dollars, Taiwan's dollars, and they're going to be looking for alternative refuge. That is going to be, in my view, Smart Silver Stacker, the principal driver of gold breaking out of its perennial $2,000 level, which is on the verge of doing. I believe it will make it this time. And then we can talk about silver. It's a little different audience from gold. Gold is really looking for central bank consumption, and silver is really for retail consumption. Nonetheless, however, there's a well-established historical gold and silver ratio you can track, and we can talk about that. So silver's laggard a bit, which is not unusual. And what we're seeing now is a replay of also 2003, 2004, when gold made a run first from 250 to about 500, and silver started out a bit 18 months later. That went from $4 to $15 in a jiffy. So this is what we see as a replay overall.
Yeah, well, a lot there to break down and to unpack. So kind of starting with the last thing you mentioned there, I think it is fairly normal if you look at previous bull markets in the precious metals to see, like you say, silver sort of a laggard. And it's usually at the end of those bull markets that you see the real compression in the gold to silver ratio. That's why I tend to focus on silver. I mean, I'm kind of a, average Joe stacker. So when I go out, it's kind of a big undertaking for me to be buying gold at $2,000 an ounce, but silver is still pretty affordable. And yeah, when you look at the valuation of the two metals, like you said, I mean, gold is knocking on its nominal all-time high. I think it's around $2,075 is the all-time high daily close. We did just have the highest monthly and quarterly close at the end of March for gold. So gold certainly seems well on its way to taking out the nominal all-time high. And then I think probably the inflation adjusted all-time high in relatively short order. I think that's around $2,600 if you use the CPI, but silver still seems tremendously undervalued to me at $26. It's half of its nominal all-time high of around 50 or close to that. And the inflation adjusted all-time high for silver, if you take the 1980 high of $50 and just using the CPI, you get a number north of $190. So silver certainly seems like the better buy to me. And I'd like to get your take on that, where you think for your retail investors, for my audience, where you think an allocation to the metals, what do you think the best value is at the moment? But also, you touched on a lot of the geopolitical stuff there and the petrodollar. And yeah, I kind of tend to be on the same page as you that will be the defining factor that kicks off this next precious metals bull market, because we've had financial crises in the past. We had the dot-com bust in 2000, 2001. We had the 2008 great financial crisis. We had the 2020 crisis. There have been several financial bumps in the road since the dollar was taken off of the gold standard back in 71 by Nixon. But the big difference this time is that it's a much less friendly geopolitical environment. I mean, we have China, they're the second largest holder of US treasuries, and they've been dumping those treasuries consistently now for the past year plus, whereas back in 2008, they were buying them. So, we had a buyer for all of this borrowing, all of this debt creation, the QE, but this time around, I don't think that's going to be the case. In fact, I think if the petrodollar system goes, we're going to see a lot of those petrodollars flowing back home at the same time that the Fed may be engaged in quantitative easing, debt monetization, and printing. So it really is kind of a perfect storm for the precious metals. Let's go ahead and circle back to that valuation of the metal. So what do you think is the best buy right now between gold and silver? Because it seems to me that silver is tremendously undervalued relative to gold.
Right. Well, the gold and silver ratio has been oscillating between, say, 30 to 100. So how do you calculate that is the price of gold divided by the price of silver. Right now, gold is about 20.50, silver is 25. So the ratio is around 80. That ratio peaked at almost 100, not only a few months ago. So usually when you oscillate, the pendulum will swing from one way and then back to the other way. And when gold was high relative to silver, and that is indication of fear, because gold is a fear indicator. And when the gold to silver ratio is low, which means when silver started to outperform, that is when we're entering the greed phase. So the reason for the underperforming of silver right now relative to gold is, first of all, people are still getting over the crisis mode, and crises are continuing with the banks, with the geopolitics, with the war, with the pandemic, and with the health mandates. So it has gone on. There's quite a bit of lingering in those fear factors that continue to drive gold or keeping gold higher than silver. And then the other factor is that because there has been a lot of slice in the economy and rising interest rates, remember that around 70-75% of the silver demand is coming from industrial consumption. So there is a slack in the industrial demand that put a damper on the silver, and that's why you're also seeing copper and oil right now are underperforming gold. And however, eventually, I think when the tides resent, I think the worst is over in my view, even for the equity market, which is embarking on reflating, scenario. Now we're going to see a bit of a stagflation coming on. And under that scenario, I think the greed is going to re-enter into the silver space. People are going to make money on gold, and they're going to rotate it into silver. And I will actually not be surprised if gold and silver ratio revert to the extreme pendulum to the other side. Like earlier, gold was 2,000, and then silver was not even 20, so the ratio was almost 100. And now we're going to see, I think, before said and done, that ratio go back to about 35, which was last time silver was $50 in 2011. And at a 35, and it's to a conservative $2,400 gold price, and I'm talking the next 12 months. And that target is also was mentioned by Pierre Lassonde, which is a legend in the gold mining space. Then you're looking at a silver price around $80. From the technical perspective, once gold past $2,000, which I believe it'll clear that hurdle, nobody really know how high it's going to go. As in the case for silver, really the $28 technical level is the level you're gonna watch closely. If silver can surpass 28 and stay over $28 for say 2 consecutive weeks or 10 working days, then silver is going to be clear to go. It could quickly go to 35. 35 is only a very minor technical resistance, and it can embark all the way to 50 and can go even higher. These kind of trades are momentum of feeding itself, because once this technical indicator got breakout, you're going to get a lot of the algo funds, unidirectional funds, momentum traders. They're going to go pile on. Nobody have any clue. Also, keep in mind, if you look at 1980, I believe silver went from $10 to $50 in less than 3 months. Same was the case in 2011 when silver went from 15 to 50 in a jiffy. So that the majority of the gain is captured in a very tight, brief window. So I just want to caution the audience, and also as the famous trader Edward Lefebvre said in the Reminiscence Stock Operator, that there are many people that can catch the bottom, but there are not many people that actually made most money, because people catch the bottom invariably will sell too early, thinking that they can repeat that bottom capturing again. So there's a lot of guys that bought silver bullion maybe at 22, 21, at a silver at 17. Then they may be cashing out at 30. I think they will be shooting themselves in the foot. This time is really this time you're looking at landscape that's completely different.
Yeah, that's true. When silver moves, it's such a small market, especially compared to even the gold market. It's much smaller market cap. So when money really starts moving into the space, I agree. I think that we will see a rapid move up. And as far as public opinion goes, I mean, it still seems like silver is completely off of everybody's radar. I mean, if you ask the average person on the street, ask your coworkers, ask your friend, ask your family, everybody knows about Bitcoin, right? Everybody knows about cryptocurrency. Everybody probably even knows something about gold. I mean, it might be on their radar, but silver, very little acknowledgement of that as even a space for investment, especially physical silver. I mean, then people almost look at you like, you're a tinfoil hat guy if you're stacking physical silver.
Yep.
And I think that that's an indication that there is a huge potential for a move up, because when that public opinion shifts and everybody is aware of silver, that's probably when you want to start looking at maybe unloading some of your holdings. And, if you see the gold to silver ratio compressed down to 35, or in 1980, I think it got as low as 16. So, maybe 35 is even a conservative estimate for that. But that's when you might want to start thinking about switching from silver into gold or something along those lines. I mean, at least that's my thoughts on it. Now, you mentioned silver going over $28, that being a technical resistance. But if you look at the physical market, if you look at what you have to pay to get a physical ounce of silver, I mean, I know it's not on the chart, but we're already there. I mean, a lot of silver products right now selling for over $30 an ounce. I know SD Bullion, they're a channel sponsor, so I do talk with them a bit, and they have told me that they see a big increase in average order value following the collapse of SVB and Signature Bank. And shout out to SD Bullion. There's a link down in the description. Anybody wants to check them out and get some physical metal. But they've had to implement a $500 minimum order just to be able to get through their backlog of orders. They've had that big of an influx. I ordered some gold from them on March 27th, and it didn't ship out to me until a couple days ago. It was about 15 days, much longer than their normal shipping times. So it seems like the physical market is already in a bit of a crunch. And again, there's not that much focus on silver and gold. So when that public opinion shifts, I mean, I think it's going to be, forget long shipping times and high premiums, it may be very difficult to get your hands on this stuff.
Well, this you got to study a bit about the history to have an understanding of the role of gold and silver. I mean, you don't have to go as far as Aristotle to talk about why gold is indivisible, is fungible, is store of value and whatnot. But since the only way to sustain the current different mandates to print deficits, there's a lot of power plays in the world, and the only way to continue to fuel their agenda or to fund their agenda is to make sure that they can continue to print. So there is a concerted effort to manage the gold and silver price, and they're doing a very good job so far. That's why the mainstream media don't talk about it, and there's a lot of different schemas and ways they can manage the prices in terms of perception, in terms of media, in terms just keeping the lid on the price of gold and silver. However, I do firmly believe, as I said last year on a couple of shows in October, when gold was 1,600, I said gold is going to break out 2,000. When silver is $17, I said silver is going to take out $28. And we're not only halfway through the year. I was expecting those levels that we're looking at right now in September. Right now, we're only in April. And given that gold is already taken out 2,000 critical level, and if gold were to sort of stay over $2,000, I just say by the end of April, then the probability of silver breaking out $20 is very, very high. And once that happens, silver is going to go to $35 in a jiffy, and it could go straight up to $50. Now, smart silver, I want to talk about why when these markets run, they run really quickly. There's a lot of smart people that are able to manage the prices for so long. There's a couple of things that they do, usually through the paper market and through the ETFs. So what they do is they will pick a strong dollar day, for example, and they will whack the futures market, which is the tail that wag the dog. The dog is the physical market. So sometimes you can have silver, for example, trading at 250 million ounces in a day in the nominal value of the futures market. So in a week, you're looking at the total trading volume exceeding the annual supply of silver. And this is not just the silver market. Same for oil, same for nickel, same for gold, all the different markets. And what happens is when the technical level is breached, it's almost like you have a hurricane in Florida, and the seawall is broken. They will let the market rip. That's smart silver stock. They will even fuel the market. So what they're trying to do is every day they wake up, they have their fingers crossed, hoping that the buying power and the exhaust, hoping that the tide will rescind. They might engineer even the interest rate rise or some sort of events that would drive up the dollar index to try to suppress gold and silver. But what they're trying to do is they will have to wait and for the peak of the market to be established in the paper market. And then from there, they will start chipping away from the ETF, from the futures market. They might even dump some physical, on a Friday afternoon over a long weekend. As you know, there's all different infamous of a Friday dump. So that's the reason that once the technical level is being breached, you really got to make sure that you stay on the right side and not get too smart about taking your chips off the table too early. Because the cartels, they're gonna even fuel the market to wait for a top to be established. And that's why I'm very confident looking at, I'm being around for 20 years, that you're gonna see a $2,200, $2,400 gold this year. And the most spectacular run is gonna be from September to December. And that doesn't mean that the summer is gonna be a whimper either. And for silver, if gold were to sustain over $2,000 by the end of April, you're going to see silver taking out $20 in a jiffy. And once they're at the $28, you're going to be, well, you can either watch the tape on a daily basis for the fun of it, or you can just put it away, put your bullions away, and then you count your chicken at the end of the year at Christmas time. But you definitely don't want to sell too early. I think that is really first of a major takeaway. I'm sure there are other points you had to mention, which you can touch upon.
Yeah, absolutely. No, I want to talk a little bit more about the manipulation, because I think that's a critical thing here. And one of the things I get pushback on this channel when I talk about stacking silver is that it seems like there's a lot of voices out there that say, hey, gold and silver are manipulated, so I don't want to stack them. But to me, it's the opposite. I think that as stackers, as folks who are holding physical metal without the counterparty risk of these paper instruments, we should be really grateful that we have the opportunity to buy the physical metals at these lower prices, because of the manipulation. And we
Yep.
know that the manipulation goes on. I mean, I think it was last year that a couple of JP Morgan gold desk traders were convicted of spoofing the market. I mean, they've had to pay almost $1 billion in fines over the past couple of years for manipulation of the precious metals markets. And last year, I mean, we saw that debacle with the LME. I think it was the billionaire Zhang Guangdong. He was the nickel magnate who had a huge short position in the nickel market. And then following the Russian invasion of Ukraine, we saw that big spike up in the price of nickel and it got squeezed.
Yep.
And what did the LME do? I mean, they paused trading. They saved their billionaire buddy. They, I mean, really did a disservice to all of the longs. I mean, that's kind of putting it lightly. I try not to use foul language on the channel.
Unimaginable.
Yeah, they really showed that these paper markets are rigged in favor of the wealthy participants, and that, you know, the average guy, if you made a right bid and you were long nickel, well, we're just going to halt it when your trade spikes up a couple 100%, and, you know, wait for everything to calm down because we're going to save our billionaire buddy. Now, do you think that we could see a moment like that in the precious metals market? Do you think that we could see a decoupling of the paper markets? You know, maybe we know there's not enough physical metal in these warehouses to back up all of the paper instruments. And maybe my thought is at some point, those contracts are probably all just going to be settled in devaluing fiat currency. And we know that officially there's not enough metal in these warehouses, but there was that story a couple of weeks ago from Bloomberg about JP Morgan had these nickel contracts, and the nickel, it wasn't even nickel, it was a bunch of rocks in a warehouse somewhere. So, I mean, the whole thing seems to be completely corrupt and manipulated to me, but I do think that's a huge opportunity. But I'd like to get your take on any of those things I just mentioned.
Right. First, because everything is, because the price discovery process is being long gone, and those markets apply to interest rates, to the dollar, to gold and silver and oil. You know, nickel went from $10 to $50, and oil during the crisis went from 100 to -15. In fact, unimaginable. So I think while you can sort of convince yourself on the fundamentals, the glass is always a half full, half empty. So what I mean by that is the street can stay the street can stay irrational longer than you can stay solvent. That's why I'm never a proponent of buying on margin. And also with that corollary, that is actually a better time to buy gold and silver now at $2,000 gold and $25 silver than it was to buy gold at $1,600 and silver at $1,650, because they could be staying in the doghouse for a long time. And I bought silver. I remember last night I bought silver bullion was $15, and that was 2015, right? So for people who bought silver at that time, they waited for 10 years of agonies and pain and suffering. That's why I think it's important to marry the technicals with the fundamentals. And therefore, I believe that with gold at $2,000 breaching that all-important all-time high level, that you might even want to wait for a week or two when gold decisively broke out of the $2,000 level, and then you just be buying silver, you know, with abandon, 26, 27, 28, 29, doesn't really matter, because that technical breakout over 28 is imminent and it's inevitable. Now we can talk about the spread of gold, say silver, physical versus paper. This is a classic indication of the tightness of the physical supply. And also keep in mind that, you know, it goes back a bit about sort of the grand schema. It is my belief that the sort of the cartels are managing the expectation and managing and throttling the retail ownership of gold and silver deliberately by limiting the supply to the mints. So I mean, there's plenty of bullions available, but all of them is directly going from the refinery back up to the trucks of the boats of the well-to-dos, okay, that are behind the curtains. And then they're deliberately throttling the supply to the mints. And that's why you'll not be surprised to see coin supply run out in January, February of every year. And usually it's an indicator when the spread of physical to paper at this level, you know, $8 to $10 is signaling a top. But as I said, this time is different. So you're going to see even wider spread of coins and bullions to the paper market. And how it's going to turn out in the end is a classic example of what happened with the nickel market. Eventually, somebody's going to step in, and like the Hunt brother in the 80s, they're going to corner the market, and the paper market is going to go wild. I mean, for those people that don't know, nickel went from $10 in a bright sunny day in March of last year, only a year ago. There was not any particular event. There was not some banking crisis or some war or some sort of attributable event, but just an ordinary day, nickel went from $10 to $50 in 2 days. Now, the unbelievable event that took place is the London Metals Exchange, which is owned by the Chinese Communist, Hong Kong Stock Exchange. They halted the nickel market for a week. They rolled back all the trades of nickel that between $30 and $50. They rolled back the trades and they settled the trades at $30 a pound. And then the nickel market then opened a week later. And even after the market opened, there was a lot of different limits. You have a buy limit, you have a sell limit, you cannot short it, you cannot long too much, and there are certain players can roll the futures market without settling the trades. So there's a lot, and then the end result is the London Metals Exchange nickel market volume was 10%, was a shadow of its former self, was 10% of what it actually is. So then what happened then is all the nickel players resort to OTC, over-the-counter, gray market. And I believe this is almost exactly the way you're going to see on the silver market, except that when nickel started from 10 to 50, if silver started at 30 times 5, it's entirely possible and plausible and conceivable that you can see a $30 silver bump in a day for consecutive days. And that will require a halt of the COMEX or the CME. And then they will roll back the trades. And that's why I'm a very strong advocate of not to also mention that they were eating away your futures with contangos. So you're not really capturing the gain in the silver prices. You're being eaten away with this contango. You have to roll over every 2 to 3 months. But you gotta buy the physical market. That is the only way that you're protected. The paper market, what are you gonna do? You're gonna go and complain and file a class action lawsuit? I mean, they're gonna settle you a few extra cents on the dollar, and it's gonna take you forever. And in the meantime, you're gonna miss that window of 6 to 9 months where the greatest gain is achieved. So I think in the end, you gotta make sure you gotta follow the technical. The technical for gold is broken out already. Silver is to follow in the next 4 to 6 weeks, over $28. And then secondly, you gotta own the physical. I bought 1 kilo of silver coins, 30 coins. I paid $55,000 at 1850. I think right now not only the gold has gone up, but the premium has gone up too. Probably I made some good money on it. But right now, anything below $28 silver on printing on the paper on the screen, and anything below $35 on the coins are absolute accumulation phase.
Yeah, absolutely. I know you mentioned the throttling of the supply to the U.S. Mint there. That's certainly something we've witnessed with the exploding premiums, especially on the U.S. Silver Eagle. I mean, on the Gold Eagles and the Gold Buffaloes to some extent too, but it's really noticeable in the Silver Eagle space. And that is, like you say, exactly because the U.S. Mint refuses to produce enough coins to meet the demand. I mean, you can get sovereign coins for a lower premium than that. I mean, the premiums have gone up, but nowhere in any product like they have in the U.S. Silver Eagle. So I think that that's spot on. As far as the nickel market, one of the nice things about silver compared to nickel is that with nickel, you're more or less, especially as a small investor, relegated to the paper market. It's kind of hard to stack up pounds and pounds of nickel bullion. But the nice thing about silver and gold is you can take those into your custody pretty easily. And, there's no counterparty risk, because I agree with you, like with any paper instrument, there's always the risk that you wake up and the rules have just been changed on you. And it's, the arena does not favor the small investor with paper instruments. Like you say, what are you going to do? Go complain, go get embroiled in a legal battle over the ability to sell your contract? I mean, that kind of defeats the whole purpose. But yeah, getting your hands on physical metal, I think, is critical. And I've never actually sold any bullion myself. I mean, I've just been accumulating, and I think that's it's the easiest way to do it. You don't have to worry. Yeah, exactly. Just accumulate. When you see a dip, if there's ever a dip on a daily basis, I like to buy on those days when I see the price come down so I can get a little bit of a deal. But other than that, it's just a pretty easy game. Just stack the metal do what the central banks are doing, right? Get your hands on physical metal.
Avoid the banking products too. A lot of them, especially in Asia, these gold and silver passports are very popular, and they would tout, say, you know, you don't pay for storage fee, and you're tracking the gold and silver prices. They're going to do exactly what the Brazilians, Argentinians, and Argentinian and Brazilians do. On a Friday afternoon, they would convert. This is what happened in Argentina. Okay, if you have a US dollar holding in Argentinian bank or Brazilian bank, on a Friday afternoon, they will close the bank on a Friday, 5 o'clock, they'll close the bank, and then they will convert your US dollar holding to the peg that they had before, either, you know, $1 to 2 Argentine pesos or $1 to 3 reals. And then on a Monday, they will float it. And when they float, it would be like $1 to 10 Argentine real, or 10 Argentine pesos, or 10 or 10 Brazilian reals. So overnight, over the weekend, your bank account, your balance in fiat just went down. So I avoid the passports, avoid the futures market, avoid these derivative products, go for the physicals. And you don't have to worry about your contangos eating away your paper gain as well.
Yeah, absolutely. Well, yeah, even in the physical market, you know, it's like a, you know, George Carlin used to say it's a big club and you're not in it. And this goes back a long way, like in the 30s when the gold confiscation occurred in the US, you know, they forced buyback at what, $21 an ounce, and then overnight revalue gold to $35 an ounce. So yeah, this is something we have seen throughout history.
And it will happen. It will happen. Yes.
Yeah, there's no reason to believe that this time is different, I don't think. And yeah, I'd be very skeptical about those paper instruments. I mean, they're fine for trading if you want to do that. But if you're looking for a long-term store value, nothing really beats the metals. There's no paper instruments from Roman times, you know, that still you can take down to your local coin shop and sell. But the gold and silver, it's still good to go.
You know what? Crazier things have happened. People say, "Oh, John, you're way out there with the loonies." Well, crazier things has happened, like an airplane disappeared in the middle of nowhere. You know, what is not to say maybe there are some terrorists that break the boat of Fort Knox, and next day people just discover that the gold has disappeared, right? I mean, crazier things has happened. And why would you want to take that counterparty risk, like you talked about, when you can own the real thing and sleep at night well?
Yeah, it's one of the main benefits of the precious metals. I mean, there's very few assets that allow you to do that. And I know a lot of folks will talk about diversification, but they've got a variety of paper assets, whereas, you know, very few of those can do what gold and silver do. So even if you're not like a hardcore gold and silver stacker, you're not, you know, piling the stuff up, it's probably a good idea to have some kind of an allocation to physical metal, just in case, you know, we do see bank bail-ins or more banking crisis. Obviously, the banking system in the US is not as sound as they would have us believe. I think Fortune reported that US banks are still sitting on $1.7 trillion in unrealized losses on the treasuries that they're holding. Yep. So, you know, there's still the room for more collapse there. And I think we're just kind of waiting for the other shoe to drop when it comes to this financial crisis. And one thing with that, the promise of bailouts from the Fed and from the Treasury, that assuages a lot of people's fears. But I think that the thing that they're missing there is that either way, there's a huge problem with these bank deposits, because either they get defaulted on or the banks fail. But if they get bailed out to the tune of $1.7 trillion, yeah, everybody will have their money, but it's all going to take a huge haircut in its purchasing power. So kind of either way, the writing's on the wall for that situation.
Well, you know, yeah, the way I look at it is the money, once it's printed, the only way the money supply will shrink is that if the money is paid back in the loan. So I am not, you know, the dilution events of one bank or two banks, it's not really the principal driver on much higher gold and silver prices. Rather, is that diversification of the reserves from now adversarial nations to the United States. We can talk about the BRICS and whatnot. But before that, though, the other thing is, as I said, I mentioned, I think it was right before the show started. This time is very different. Imagine if the Silicon Valley fiasco or debacle would have happened back in 2013 or 2014. You had Janet Yellen going on a Fed meeting and an emergency rate cut of 75 basis point, right? You have Deutsche Bank, you have UBS, Credit Suisse, they're going under. I mean, these are huge mega banks that would have called for immediate quantitative easing around the world, but yet that is not happening. So this is telling you that this time is we're breaking out of a 30-year to 40-year interest rate bear market, and we're going to get a temporary breather, but rates are going to go a lot higher. I think so. Those people who are looking for sort of a counter rally trades of the of gold and silver, thinking now it's time to put some gains, I think we're going to miss the boat in terms of the long term. We're going to see rates going a lot higher, and in terms of the events take place. If you look at 1997, it was the Asian financial crisis. You look at 2009, that's the mortgage crisis. I thought you're not going to get anything bigger because the U.S. mortgage market is one of the largest markets in the world. And then, yeah, lo and behold, 2019, you got a health mandate that turned the world upside down, that caused hundreds of millions of people go hunger on the street. I mean, in fact, it's 10 times more devastating than it was the 2009 crisis. And guess what? I would not be surprised of another major event that takes place before 2030. I do have some clue based on my research of what I believe will happen. I think something along the line of a major cyber attack or some galactical event that would shut the power supply down for an extended period of time. So, I mean, Silver Stack, can you imagine the world without power? Like all your EVs are going to be the wayside. Your bank accounts are not accessible. And the only thing you're going to be holding on to are the gold and silver. Not to say the world's going to go in doom and gloom. There's always on the other side of the tunnel. And it's just that you're going to have your picking on what you want to buy and what you want to own when you have that basket of physicals, when everybody else is in despair, trying to recover their, like, your smartphone is not going to work. There's no 5G. Can you imagine a world like that? And can you then imagine sort of the comfort, sort of reassurance you have owning gold and silver? And that is really, I'm not really sort of sweating over a Silicon Valley bank. Nobody really knows what's going on in the banks. I mean, once you put the money in there, the fractional reserves already long gone. Nobody really knows what the hell is going on. I mean, that is really factually speaking. Nobody has any idea what they're doing in the banks. So, and now with the unpredictable Fed, with a different set of ulterior motives now. Before they were trying to lend you money and have you heavily in debt, and now the motive is coming home to roost. They're gonna force you to own nothing and be happy. So I will not be looking for any major bailouts. You're gonna see the resumption of rising interest rates by the end of the year, and you're gonna see a lot more uncertainties going forward, and with some major sort of major climatic event that happens maybe 4 or 5 years from now. It's all going back to the rationale of owning more gold and silver, and that's exactly what I did a couple of months ago. Buying gold, first time I haven't done in more than 10 years. The reason I didn't buy silver was in Taiwan, in Asia, there's tax on silver, but there's no tax on gold. But I'll be making a stop in Canada, and I do have residence in Canada. I'll be buying silver at these prices, for sure.
All right. Well, thank you very much for tuning into part 1 of my interview with John Lee. I hope you enjoyed that conversation as much as I did. Kind of an ominous note to leave off on there regarding a potential cyber attack, but we will be digging into that topic and much more in part 2, which will be getting launched tomorrow, so be sure to stay tuned for that. And as soon as that is launched, I will put a link to part 2 down in the description and in a pinned comment, so make sure you check that out. And that being said, thank you very much for watching, everybody. Stay safe and happy stacking, and I will catch you next time. Smart Silver Stacker, out.